This is the Chester County Real Estate Podcast, bringing you the info you need to make your next move a great one. This show is brought to you by RE/MAX Ace Realty. For show notes and links, go to acerealtypa.com/podcast.
Hey everyone, welcome to the Chester County Real Estate Podcast. This is the show that gives you the information you need to make your next move a great one. And today I'm sitting down with Mike Izzi, having Mike back on the show here. We're going to be talking a little bit about affording houses, how much you can afford, and really what kind of house and what you should be looking for when you go to look for a house based off of what you can afford. So real quick, Mike, why don't you just tell us a little bit about yourself?
Yeah, thank you, Sean. Thanks for having me today. And my name is Michael Izzi with McLean Mortgage Corporation. I've been doing loans locally here in the Chester County area for about 20 years. And I run a branch out of Exton.
Okay, cool.
So, yeah.
And so you've been, and are you from the area, or you've been in the area for that long, right?
Yeah, thanks for asking. So born and raised in Malvern, went to Great Valley High School, went to Penn State, and still live locally in Downingtown.
Nice.
Yeah.
I guess the big question that I always get is people saying, well, how much can I afford? Or if we're talking about from a realtor standpoint, they're showing me, when you first talk to someone, I want to buy a house, and they give me a list of houses that they really like, and I got to inform them that that's way too much money.
Yeah.
That they probably won't be able to afford it. And usually the soft conversation goes, why don't you talk to a mortgage lender?
Mm-hmm. Yeah, exactly. Affordability is everything in my world. So everything in our world is based on the ability to repay that loan. Mm-hmm. Okay, so it's a very popular question, and a great starting point when thinking about buying is to have a conversation with me or someone that does, lending like myself. It's never too early to have that conversation, to kind of start that planning in place. So whether you're buying in a month or a year, it doesn't matter when. You want to have that conversation, educate yourself, and kind of prepare yourself.
Yeah, I always tell people that really, once you understand what you need, even if you walk away from that conversation and it's not exactly what you were hoping to hear, because I remember when I was a lot younger, I was so ready to buy a house. Once I talked to a lender, it was like, you're a year away. You're right. A little bit away from this. And I was crushed. Now, I was in my 20s. It was probably 2006 or something like that, because everyone was buying houses. And it hurt, but it was really good to know. And at the time, it felt like, oh man, I'm never going to get a house. Like, I have to wait 2 years before I have documented income. And now it's like, oh, that's no big deal, having been through it several times. But at the time, it felt like a lot. So what are some of the things that when someone comes to you, what are you asking them? What are you looking for?
Sure.
And what's going to matter when it comes to qualifying for a house?
Yeah, good question. So when I had that initial consultation, that's more of an educational call where we're just kind of going to gather some information. We're not going to run credit. We're not going to go and look at a pay stub or anything like that. We're just going to ask questions about their credit, their income, and their assets. Okay? And during that call, specifically for credit, let's say. Okay, so I just want to get an idea of what the range of credit is. So is it excellent? Is it good? Is it fair? Is it poor? Okay, that way I know. Okay, if it's poor, we got to do some work before qualifying for a mortgage. So I can kind of coach that person through improving their credit scores or limiting their debt. Okay, so as far as credit is concerned, if someone has a credit score over 740, that's considered A+. Okay, and we'll likely go with conventional financing. Okay, once you get into the mid 600s or lower, then we look at alternative products like FHA or VA. Okay. Which have kind of relaxed guidelines for someone with a lower credit score. They still get a good rate, okay, versus conventional, might not be a good rate, might have high PMI, stuff like that. So
you can still get, so when you're in that mid-range credit score, you can still get a conventional loan. It's going to be a higher rate.
Yeah, the terms aren't as favorable. Exactly.
And one of the advantages, too, in FHA loan, did you say also VA?
VA, yep.
Is that there's more flexibility as far as credit history, credit score, stuff
exactly.
like that goes.
Yep.
Okay.
So you can have a 620 and still get a house, but you'll get more favorable terms if you go FHA versus conventional.
Gotcha.
Okay. Believe it or not, the minimum credit score for FHA is 580.
Okay.
And the minimum for conventional is 620.
Okay. Now, does that ever change? Like, how much has that changed?
Hasn't changed in a while, but I'd say FHA used to go to 550.
Okay.
And then things got a little tighter. So the rules kind of changed with the market.
Now, with FHA, if you have the higher credit score, do you get better terms?
No, not necessarily. You can have an 800 score and a 700 score or a 650 score, and the rates will be similar for FHA.
For FHA.
Yeah.
Okay, cool.
Yeah. Versus conventional, it's not. Okay. Nowhere close between a 650 and an 800, let's say. Yeah.
That makes sense.
Yeah. So when you're preparing yourself to buy a house, obviously the higher the credit score, the better, because that's going to give you the best rate and the best terms of your mortgage.
So the first thing is to make sure you have a good credit score.
First, establish credit, right?
Well,
so if you're a
establish
first timer, right,
You're right.
You might not have a credit score. Okay. We typically ask for 3 trade lines. Okay. So for instance, 2 credit cards and a car would be 3. Okay. Maybe a credit card, a student loan, and a car would be 3. All right. So we prefer to have 3. There's alternative products that we can look at with less than 3, but that's a good rule of thumb. Okay. Now, for someone that is new to that world, you can't just open up 3 credit cards and then automatically qualify for a mortgage.
Right.
Okay. You want some history. We want to see payment history because that's going to allow the bureaus to generate a credit score. Okay. When you initially apply for a mortgage, the hard inquiry will ding you about 10 to 15 points. Okay. And then we're going to use the middle score out of the 3 to qualify that person.
Real quick, the hard inquiry, that's when you're getting the pre-approval, there's a hard inquiry, or is
There
that
is.
when you're actually applying for the mortgage?
So in the initial stage,
Yeah.
the initial step is a hard inquiry.
Good to know.
Okay. And that's like a necessary evil. Like I have to do a hard inquiry in order to do my job. I can't do a soft pull.
Yeah, and when you say necessarily evil, it's because if it was just a soft pull or not an accurate number, then that pre-approval that you're handing in with your offer isn't really going to be worth as much.
I can't even do a pre-approval with a soft pull.
Now, there's also, on that note, I know we're like jumping around a little bit here, but a pre-qualification versus a pre-approval.
Sure.
Is there a difference? Is it just a term, or what does that mean?
Yeah, so pre-approval is where everything's verified. Okay, so we've run the credit, we've gathered all the income docs and all the asset documents, so there's not going to be any surprises during underwriting. Okay, a pre-qual is more of a conversation, maybe a credit check, but nothing's verified.
Okay.
Okay, so when people present offers, no one's really presenting with pre-quals because it's not worth the paper it's printed on.
Yeah. So an agent's going to see that. They're going to be like, oh, wait, this isn't an actual pre-approval. And I know this is, not to jump too far ahead of ourselves, but a lot of times an agent will give you a call, or you'll talk to the listing agent and actually explain to them that you pulled their credit, you did everything, so you were able to verify everything.
Yeah, and that is the one thing I do when an offer goes in. I'll reach out to the listing agent and give them praise on the credit, income, and assets that I've already verified.
Yeah, and so anyway, so just and that's just because when people hear like hard inquiry, ding your credit, stuff like that, they get a little bit nervous, a little nervous. But in the end, it's to your benefit.
It
really.
is. It is.
It's like you don't have to do all that, but then again, you don't have to, buy a house.
Right.
And in a competitive market, the seller is going to be looking for little things like that. And if the buyer's motivated and if they're nervous about that, then it's like, well, why would they why would they take their house off the market for an offer when someone was too nervous about dinging their credit score a little bit to actually get a real pre-approval to prove that they can borrow the money? So
yeah.
All right. So we hit the credit scores. What are the other things that you guys are looking?
Yeah. So remember, everything's on affordability, right?
Yeah.
And we look at what are called debt to income ratios. Okay. So not only does the credit report provide me with a score, but it also provides me with all their debts. And we look at monthly obligations. Okay. A good debt ratio is anything under like 45% of their income. Okay, so if a first-time home buyer, let's say, knows what their income is, let's say it's $5,000 a month. Okay, we take 45% of that number, and that's the max debt they can take on for a mortgage.
Okay.
Okay, so we subtract any existing debts off that number, and whatever's left over is the mortgage payment that they can afford.
Now, what existing debts? What does that include? That includes you said car payment. Other house payments if they have another house,
Sure.
obviously. Credit cards, then?
Yeah, credit cards, anything on credit. So credit cards, car payments, student loans, mortgages, personal loans. But we don't get into utilities. We don't get into childcare, nothing like that.
What about child support?
Yes. Anything that's court order, we have to count. Yep. So, and there's certain rules behind child support, whether you're receiving it or paying it out. But yeah, we do consider that, alimony, stuff like that.
Okay, cool.
Yep. But yeah, childcare expenses can be expensive, and they're not included in our calculations. So I always recommend to buyers to create a budget and make sure we're counting everything: cell phone bills, utility bills, childcare, all that, to make sure they're not going to be house poor.
Now, what if they're allocating a certain amount of every paycheck to a savings plan, or there's like an automatic savings thing or something like that? That doesn't, because that's something they could stop. As long as they could stop it, the mortgage company isn't quite.
We're going to go off the gross income.
A lot of times when I'm talking with buyers, sellers, whoever, I differentiate between what they can afford and what they can qualify for. So because you're bringing up the stuff like what the items that don't show up on a debt to income calculation, it doesn't necessarily mean they can afford it just because they can qualify for it. And sometimes they can afford more than what they can qualify for various reasons. So to me, what you can afford is more of like a personal decision and how much you're comfortable with and how much you need on hand for your living expenses and stuff. Whereas what you can qualify for is more a financial question. But in general, from the buyer's standpoint, they're pretty interchangeable too.
They are. So Tyler recommended put a budget together, put the alternative things that we don't look at, like childcare expenses, utilities, cell phone bill. We don't use that in our calculations. So make sure your clients are putting a budget together, and don't overextend yourself. Okay, you can alleviate a lot of stress by putting yourself in a good position when you're buying a home, rather than trying to overextend yourself or buying that dream home where you're stretching out that payment. You never know what could pop up. So there's a common denominator with people with good credit. Typically, they have lower debt ratios because they don't overextend themselves.
Gotcha.
Okay.
So I guess the next thing was cash on hand.
Yes.
When I was a first-time home buyer years ago, that was the biggest hurdle that we faced, and back in the last big recession crash. What are you looking for with cash on hand, and how do you verify that?
Sure. So when buying a home, not only do you need money for your down payment, but you also have closing costs, which a lot of first-timers don't realize there's a lot of costs involved when buying a home.
Yeah.
So there's a lot of parties that get people to the finish line, right? So there's people like myself and appraisers and title companies, realtors, insurance people. There might be 40 people that touch that file from start to finish. All those different parties charge fees. Okay. So up front, I want to make sure that they have enough money for their down payment and to cover all your closing costs as well.
Well, on top of that too, you also have escrows, right?
Yeah. Yep.
You have to have that money ready. So basically, on top of on top of those fees, you have to have. It depends on the area, and there's different calculations, but basically a year or so of cash in the bank in an escrow account for the taxes. Yeah,
a whole year of taxes, a whole year of insurance. Yeah. There's going to be some interest all on top of your closing costs. Okay. Yeah. So typically closing costs, well, not typically, but sometimes closing costs are higher than your down payment, depending on like the price point and how much you're putting down.
Right.
Yeah.
I remember. I hope it was my first house. Maybe it was my second house. I remember buying a house years ago, and I remember calling the lender, and I was like, "What's with all these costs? Like this is high. Like I knew it'd be high, but this seems really high." I thought he was like pocketing some of it or something.
No.
And he explains it to me, and I'm like, but I'm paying taxes, but I'm paying my taxes now in my mortgage payment, because I kind of understood what was going on. He goes, no, you're paying next year's taxes now. Like, but there's basically like there's that padding because the bank wants to make sure that those taxes are already paid for as far as possible, at least a year in advance.
Yeah.
Because the bank doesn't want the government coming in and taking their collateral away. So
both insurance and taxes are paid in advance, so you're always paying ahead.
Right.
So for instance, let's say we're closing today, you have to pay a whole year of insurance, so now you're covered for a full year. But in addition, we collect every month to cushion that escrow for next year's bill.
Yeah. So that makes sense. Now, as far as where that money comes from, that cash on hand, because that's another question too. Well, it's like, well, can you borrow the money from a parent or to put down on a house? Yeah.
So a good rule of thumb is you can't borrow money to borrow money.
Right.
Okay, unless it's your own. So, for instance, I've seen people take loans from their own 401k to supplement their down payment. There's that going on.
Now, real quick, would that count against their debt to income ratio?
No, because that's going to be pre-tax.
Okay.
Yep. And then I've seen people get gifts from family members. Can only come from immediate family. The gift amount is unlimited, whereas in the past there used to be caps, but not anymore. Okay.
And usually that's accompanied by a letter of some sort that says this is a gift. It doesn't have to be repaid.
Yeah. So, you had mentioned loan from parents. We just call that a gift. Okay.
Right.
So that's just a gift. What happens afterwards is up to them.
Right.
Yeah.
Right.
Okay.
That makes sense.
Obviously, savings, checking, investments, there's other avenues as well. So when we're going through our consultation initially, I educate them on the cash that they need to qualify. And then we try to figure out ways that we can come up with the cash. And if we can't, then they know they got to save up.
What about seasoning that money? Don't you? Because you look at bank statements too, right? So,
Sure.
So if that money was dropped into the account, it's within the last couple of months or so.
Yeah, we're going to go back 2 months of bank statements.
2 months.
Okay. And if there's any large deposits in there, then we're going to want to know where the source came from. Yeah.
And mostly that's because you need to make sure it wasn't another loan.
Yeah, loan. It could be mattress money, like any.
Yeah.
It has to be verifiable. Okay. Money from a friend, that's not verifiable. We can't count that.
Right.
All right. So any large deposits are going to be red flagged, and we're going to investigate a little bit further, find out where the money came from.
Now, let's say they sold a car and they sold it for cash. A lot of people do that. It was a private sale. How do you verify that money, where that money came from in a situation like that?
Copy of the check and a copy of the bill of sale.
Okay.
Yep.
Gotcha. So if you are selling a car for cash, keep all the paperwork. Keep that paperwork.
Yeah. It's gonna come back to you.
Gotcha.
We're gonna need that paperwork.
So once you have that number, so once they talk to you, would they have that number?
Yeah.
on hand?
So we went through the credit conversation, right?
Yeah.
Now I know what program they're going for. I know how much debt they can take on. Then we go through the assets. We also go through the income, which is a big proponent of what they can qualify and what they can afford. Okay. We like consistency. Okay. We like guarantees. Salaries are great. We love that. Anything variable, though, it takes a little bit more time to calculate that income, right? So if someone's paid hourly, overtime, maybe they get bonus, maybe they have commissions. These are all types of variable pay where we like to see history or a track record, okay? Think of it from the underwriter standpoint. They're putting their name in the line, right, for this loan. They want to make sure it's not going to foreclose, right? So they're using this income calculation to come up with that decision, to render a decision, right? So they like consistency.
What about something like servers, cash tips, stuff like that?
It's tricky.
Yeah.
It's tricky. When you're in a cash business, sometimes they don't show as much on paper as what they really make. That comes back to bite them when it comes time to get a mortgage.
Yeah. So if you're thinking of buying a house, it's good to try to have documented income.
Absolutely.
Yep. Even if it's not something you've done in the past, but you're probably going to have to do some of that.
And we like consistency. Like, I've seen people on the job for 6 months as a server, and then 6 months as a landscaper, and then 6 months as something else, and so forth. That's not consistent income. Okay, it's different lines of work and stuff like that. So we like to see consistencies.
If someone does have seasonal work or something like that, if it does repeat every year, like it's going back and forth and stuff, do they just go back farther and be like, okay, well, you've done this, we can average this out a little bit more?
Exactly.
Like,
you want a 2-year
that?
history. That's the magic number, is 2 years for any type of employment. We like to see a 2-year history. Okay. Now, let's say you went to nursing school and you're going to become a nurse. You might not need a 2-year history as long as they can guarantee you're getting 4 hours a week or whatever. Okay. But good rule of thumb is we want to see a 2-year history.
Now, switching jobs, that's one of those, like, the things you should not do when you're about to buy a house, right? However, sometimes it does happen. Is it true that, like, if you stay within the same industry line of work, sometimes it's not always a problem?
That's correct, yeah.
Okay.
So someone gets a new job, let's say during pre-approval, right? So they're already pre-approved, they got a new job. I would want to see that offer letter to make sure that their income is going to be the same or better. Okay. There are times that we can count the new income like the day they start the job. Okay. And then we do some collecting of gather some documents after closing.
Yeah. And that's assuming it's not a salaried position or they have, like, documented
salary's
promise.
easy. That's easy peasy. If they're not salaried, then we might want them on the job for a little bit longer.
Gotcha.
Yeah.
Okay. All right, cool. So with all that, so that's basically the information that you're getting up front in order to qualify, to get a pre-approval, stuff like that, right?
Credit, income, assets. All right, that's all I need to just educate them, find out what they can, kind of the sweet spot that they can qualify for. Okay, and then the ball's in their court. Whenever they're ready to get pre-approved, they apply with us. We run the credit, verify all the income. You did ask about verification of assets. We asked for 2 months. 2 months
Right.
bank statements. Some banks will automate that for us as well, so it kind of keeps the paperwork limited. But yeah, once I have all that documentation, it only takes about a day. You get pre-approved, and that pre-approval is good for 4 months.
Yeah. A lot of times people don't understand that there's not necessarily a solid number that you'll be able to give them, because they go through all that and they say, okay, I'll look at houses up to what, 400, 450, 250, whatever it is, and you'd be like, well, there's some variables there, and you'd say, give me the address, and I'll let you know if you're approved for it or not. Buyers, they just want to know. They're sitting at their computer at night. They just want to know what they can look for, whether it's 420, 430, 440. Just give me that number, and I'll look for something underneath that. Can we talk about a couple things that go into the cost of a house and what they're going to be qualified for? Because really, what it is, you're giving them a monthly number that they would be qualified for the most part, depending on their credit score, program, and down payment. But it's mostly a monthly payment that they're looking at, right?
Yeah, and we call it PITI.
Yes.
Principal, interest, taxes, insurance. PITI.
Yep.
All right, so it's not just the mortgage payment, but we have to also add in the taxes on the property and the homeowner's insurance and possibly mortgage insurance if there's any PMI, which is less than 20% down. Okay, so it's the total payment, not just the mortgage payment.
Right.
Okay, and that's all part of that 45% debt ratio calculation. All right, so what we do, we take all the debts that they currently have, add the mortgage, and we want that to be within 45%. Now, when I do my initial consultations, I start off with the 45%, knowing that we can actually go a little bit higher if we have to. Okay, but that's a good kind of comfort level, or
Like a target.
yeah, exactly.
And then like some other things like HOA fees.
Yeah, that's in
so
there.
that's going to affect your PITI payment, your mortgage payment, and what you can afford. So on a practical level, you're looking at a place that's $150,000, and then you're looking at condo, it's $150,000, but there's a $250 HOA or condo fee.
Got to knock out that debt ratio.
Yeah, so that's going to be a completely different affordability factor than something that doesn't have that. Now, if the taxes are lower over here and the taxes are a lot higher over there, that's going to affect it as well.
Yes, you're exactly right. Yep. And property taxes vary, like in this local area here.
Yeah.
Coatesville might be the highest, Downingtown might be a little bit higher, but then Westchester's a little bit lower, Malvern's lower, and stuff like that. So it really depends on neighborhoods and everything too.
Yeah. And a lot of times when you see a drop in house values, it might be because the taxes are a little bit higher in that area.
Sure.
Could be because the HOAs are really high too. So it's something that, you need to look at. And kind of goes back to that whole question of what can I actually afford?
Right.
So yeah, you might be able to afford $400,000 at a certain monthly payment, but at that same monthly payment in another area, maybe that's $420,000.
Right. Interest rates have a lot of a factor on it too.
Yes,
we've been seeing interest rates go up, and people I spoke with 6 months ago might not qualify for that same price point today.
Yeah, and that also affects the sellers too.
Sure.
So we keep going. It's commonly understood that when interest rates go up, that means that the buyers can buy less. But when the buyers can buy less, the sellers, that's going to affect the housing prices.
Lowers the demand.
So in the macro view of things, it's really the sellers that get hurt, because those same houses are going to have to drop in price if the interest rates go up
In a way, yeah. Buyers are paying more though too.
They feel it. The buyers are the ones who end up feeling it, or at least feel it first.
So we have our initial consultation. Okay, we're talking about their credit, their income, and their assets. Remember, we're not pulling credit. We're not looking at a pay stub. We're just educating them. Okay. By the end of the call, that buyer will know what price range they qualify for, what their monthly payment's going to look like, how much cash they're going to need to save up. Okay. So now they can exhale. They're like, okay, well, I can make this happen, right? Then the ball's in their court. Whenever they're ready to get pre-approved, like I said, it could be a month, could be a year, right? It's all the same things we're looking at. Okay. When it comes time to pre-approve, they apply online. They supply their documents. It's good for 4 months. I always tell people that once you're ready to hop in a car to start looking at houses, that's when you want to have your pre-approval done. Okay. It's not wise to go out looking at houses without a pre-approval, because that house might get sold from under you, and you might have fallen in love, and now you're heartbroken.
Yeah. And then you get all angry because, like, Mike, where were you? I called you at 10 p.m. to get my pre-approval.
Yeah, right. No, but we work weekends and stuff. We understand that real estate doesn't sleep.
Do your best, but you are human, right?
We do have a family.
So I try to tell people, it's just a matter of if you want to be in the best position possible.
Right.
And that means getting prepared as early as possible so that when the opportunity arises, you can shoot.
You're ready to go. Yeah. Do not look at houses, go look at a house, no pre-approval, and then rush through it. It's a major decision. Most people only buy 1 or 2 houses in their lifetime.
Right.
So it's best to be prepared.
Cool.
Yep.
Anything else? Or
establishing credit. Remember, we like to see 3 active trade lines. Mm-hmm. Okay, it might take six months to a year to establish credit if you're just starting. Mm-hmm. Okay, so definitely prepare yourself in that fashion.
Okay, cool.
Okay, if you want to get in touch with me, there's links below. Okay, there's a link to apply online if you want to skip that, or you can just schedule a call by clicking the other link.
Okay, cool. Yeah, we'll put those links in the description, and if anyone for some reason they can't get to those links, what's the best way for them to get in touch with you?
Sure. My website is michaelizzi.com. MICHAELIZZI.com.
All right, man. Well, thanks a lot. I really appreciate it.
It was a pleasure.
Thanks for listening. This has been the Chester County Real Estate Podcast, brought to you by RE/MAX ACE Realty, serving buyers and sellers in the Chester County area. Subscribe for new episodes at acerealtypa.com/podcast. And you can find us on Facebook, YouTube, and wherever podcasts are found.
This episode is brought to you by RE/MAX ACE Realty in Downingtown, PA. Whether you're looking to buy or sell a home, we have a real estate expert for you. Search for homes or contact an agent at acerealtypa.com.